Hello, ladies and gentlemen, and welcome back to a special weekend edition of the markets around the world. A lot of people are confused right now by markets, and rightfully so, but will this week sort it out? Non-farm payrolls, FOMC and interest rate decisions, and on top of that, earnings. Yes, we have stocks that are expected to move upwards of over 10% leading into their earnings reports this week, and they're not just small, they're absolutely massive. With stocks like Tesla running out of control and a whole bunch of retail traded stocks from 2020 and 21 resurging at the moment, it's easy to have the FOMO. Should we be careful here? Well, let's find out together right now. Well, welcome back everybody to the Daily Show where we talk about markets around the world. We're covering stocks, commodities, and cryptos in detail in today's video, but we'll start off with the news, the macro, and the lead indicators that you need to care about. So this little known indicator is bullish for 2023. Now, I'd agree it was a little known indicator, but now everybody's talking about it. What is it? It's the trifecta leading into the end of January. Basically, the Santa Claus rally, first 5 days, and January returns being positive with a negative year before have generally been incredibly positive. I doubt that the stats are going to work out this year. Too many people are talking about it, but still, it's a great one to have in the back of your pocket in previous years. And I think in the future, when people forget about it, it will become a thing again. Let's talk about smart money versus dumb money confidence. We haven't looked at this chart in a few days, but it continues to be smart money inflows reducing or staying basically stable, and dumb money, that's us, retail traders, continuing to pile into this market. Is this the start of a new bull rally and we're truly in it, or is something more sinister happening? Well, dumb money would say there that maybe it's a bit more sinister. We also know that if we look at money flow from the big funds, they're pretty consistent over the last couple of weeks. In fact, they've been consistent realistically since October. They have been net purchasing at a faster rate than they were previously, but this blue line here shows you that they haven't really stepped it up, and that's that smart money inflows. If we start to see the big funds appearing and purchasing huge portions, then we really need to be paying a lot of attention. At the same time, hedges have actually started hedging in the direction down. That's the green line. And what that tells us is that there is a little bit of fear in this market, and there's still some big players betting very heavily to the downside. Is that Barry? Probably. He'd be in there, I'm sure, with a whole bunch of others. So what about S&P 500 weekly performance? Well, we're about through January and we're about to enter into February. Historically, a pretty poor time for markets. In fact, you'll see here with average weekly returns, that kind of week 4 into week 8 tends to be a little bit worse than some of the others in the year. Now, a lot of people don't know this, but if we took statistics from 1928 all the way to now, you'll notice that actually one of the worst months of the year on returns tends to be S&P 500, and it's February. And this is a bit surprising to a lot of people. Of course, we all know about September. We all know about sometimes people say sell in May and run away, although that's questionable. But actually, February has become one of the weakest periods. And remember, in Q1, the VIX tends to spike the second highest prices of the year. So will we see some volatility come back in? I always say on this channel, and I always talk about it with everybody, is you can't have FOMO. If you've missed a run, so be it. Look for the next opportunity. And I think that things like February and March could bode poorly for markets. We've got more charts on that coming up in subsequent videos. So make sure to subscribe to this channel if you haven't already done so, as you cannot miss out on our research into that area. Fear and greed index, 69 for fear, for greed, I mean, in this case, and it's pretty greedy. It's not extremely greedy, but you can see a month ago we were sitting at 36. Now all of a sudden we're greedy. How fast markets switch, and it's not even like we've returned to extremely high zones. We'll look at that when we check out the charts a little bit later on. What about S&P 500 forward PEs? Is it cheap to buy the market right now? Well, basically, as an investor, it's kind of like fair value. It's a little bit higher than fair value. We're sharing these over on our Twitter every week during earnings season, and we'll continue to do so. Forward PEs are a great way of looking at markets, and I think this is a great way of being able to step back and say, well, even in times of fear, is this worth it historically to purchase in at these prices? Some people use PE. I prefer forward. It is basically always adjusting. And if you can get the numbers, which we'll share here throughout the year of 2023, then you want to be paying attention. Notice the back end of the S&P 500, the 400 and the 600, they're much lower. And that just shows you how many people are stuck in the big stocks, and they're the ones that are really holding the big values. Now, we're also sharing over on Twitter, follow at FX Evolution, link in the description down below if you're interested, some expected ranges this week. We've got the S&P, the Qs, and of course the Dow Jones and Russell. Now, we know that these markets tend to hold about 68% of the time in terms of the high and low, and you can use these as kind of, I would go with like some form of resistance or support in terms of key levels, and you adjust them and put them on your charts, and they can be incredibly helpful. So make sure to pay attention to those. So we mentioned massive implied volatility. Check out Meta, over 10% expected volatility. That's on Wednesday. But this marks the biggest week of earnings. No wonder they've got the FOMC. No wonder they've got the non-farms. It is just absolutely stacked. I really cannot think of a time that's more stacked with economic news. Meta, Amazon, Apple, that just to mark a few here. And you can see there's some other giant names coming out. These are all the implied vol moves, and it's a great chart to be looking at. So just before we jump into the actual charts and take a look together at the key levels that you need to be watching, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Tiger Brokers are offering a special deal up until the end of the Chinese New Year. And basically, if you're interested, you can look at the description links down below. But remember, there's a whole bunch of extra special offers as well for members of this community. Now, why would you potentially want to check out something like Tiger Brokers? Well, one of my favorite features about their platform has to be being able to look at sectors and, more importantly, concepts. And during times such as money flow, like we've seen recently, it's paid to know what's doing well and what's doing poorly. You can see here as of the Friday, SPACs, Tesla concepts, solid state batteries, EV chargers, ARC ETFs, and of course AI and 3D printing. They were some of the best sectors of the day. And what this really helps you do is it helps you figure out where the money flow is moving. If we think about change of 20-day movements, you'll really see here solid state batteries are up 64%. Yes, that's right, 64% over that period. Once you get into the flow tends to last for a little bit long, or a little bit of a longer time than you expect, and then it just suddenly usually gets moved out of. But there are ways and means of doing this rotation. Remember, if you take 2/3 of the move, you're doing a great job. So why not check out Tiger Brokers down below in the description. Let's move over to the VIX. Well, the VIX is sitting at 18.5. Historically, in 2022, this was a time to be a bit scared in the markets and to be cutting back on positions. We'll have to find out whether it is again, but 18 is certainly quite low for this market. TLT, this is the Treasury bonds. What are they doing? Just sitting in a range. We spoke about it the other day where we believed it would probably short off this level. And at the moment, it's sitting a little bit lower. I wouldn't mind it to come back down to like a 102, but I think Treasuries will have their day into the FOMC and the interest rate decision. That's probably when they're going to move the most this week. Speaking of interest rates, here's the US 2-year, and it's not dropping. So you would think, oh, well, the market's going up. Wouldn't you see US 2-year dropping? Well, they're just not. Here's the US 5-year, again, not dropping. Here's the US 10-year, not dropping. So it tends to look like at the moment we're waiting for that big news, whether it's the non-farm payrolls or the FOMC statement and reports. I'm not sure which one's going to do it, but I expect some largish moves on the interest rates this week, and that's something to be definitely looking out for. Let's have a look now at the US dollar, and the US dollar has considered this level twice now and created two long leg dojis. So we have lows, we have highs, and we have opens and closes basically at the same level. This is the level of equilibrium at the moment for the markets. And we know that the dollar wants to make a fairly large move. If it goes onto the downside, expect it probably to crack 100 and every single person to be talking about shorting the US dollar at this point. That's where you would have to expect actually to do the exact opposite, and you'll be looking for those reasons. But at this stage, are we in accumulation towards the upside or distribution towards the downside? Let's take a look into the under the hood for this particular pair. And what we're currently having a look at here is effectively a market that keeps making kind of like lower peaks I'd love to see the US dollar actually find some strength in it. You'll notice we have alerts set about 102.35 to 39. And the reason we've got that is because that will take out these previous peaks and actually prove maybe some accumulation is in. But for now, we don't have too much reasoning either way. You can see these wick rejections possibly pointing towards the downside. If it does get underneath this level again and close, I wouldn't be surprised at all to see the US dollar sitting at like underneath 100 or around 100. That's parity on the dollar index relatively fast. If we end up breaking through onto the upside, well, there's some great moves to the upside as well. We're watching it. You've got to have it on your charts. Let's move over to gold. So gold continues to hold pretty much all these nice demand wick zones. We saw a little take of the lows here. See how it got underneath that little low there and it took it? Well, if it breaks above this level, 1935, I think intraday scalping could be very interesting. Little pullbacks through that particular session, if this does occur, could lead to upside. At the moment, the trend is still heavily intact towards the upside, so you've got to be very, very careful when trying to short it. If you do see closure points underneath this level here, so that is the market comes down and doesn't just instantly reject like it's been doing, then we can start talking bearish. But at the same time, you'd see the dollar index most likely go up and, of course, move accordingly. Let's move over to US oil. No strength here in the weekly. Obviously, it ended up down. If we move over to this particular chart, we still don't have proper definitive closeouts above that 83, which we were thinking would send us to about 89 or even 92. We know we're in Chinese New Year at the moment. Sometimes oil does drop after that period, but yeah, it's coming back down to its heavy demand. So basically, charts levels to watch this week will be around that 78.60 to 78.20, and whether we see buyers recommence themselves here. We know we're in something. Is it distribution or is it accumulation for the next moves? We're not sure yet. But at this stage, we're cautiously optimistic because the trend has been going up recently. The buyers hopefully should recommence in that level. Let's move over to commodities and we'll talk about copper. About 2 weeks ago, I mentioned this zone, and this was a very, very key zone. I cannot tell you, this is a serious zone for me. And as again, we're going into Chinese New Year, generally you see commodities rally through January, very big bulls on gold, very big bulls on iron ore here in Australia. We have a lot of that red dirt, but also the copper. The copper usually shows the health of economies. Sometimes it can also tip over. And if it tips and the stock market keeps going up, well, there's an alert sign. They call it Dr. Copper for a reason. Now, at the moment, it's at the absolute critical zone. You'll notice we have alerts set just underneath 4.1, just in case it goes under there. And that will hopefully show us maybe some early risk off sentiment in markets. Watch copper this next couple of weeks. Materials has been on fire, absolutely hot, and I'm definitely keeping an eye on that chart. Let's move over to the one, and yes, I'll admit it. Okay, I thought this would stop between 150 and 160 this week, or the week that just happened. And I got to say, yeah, you guys pushed it through. Obviously, too many calls and a huge squeeze going on here from short selling. Tesla absolutely knocked out of the park, another 11%. But, for the bulls or the bears, you've got to start being really careful. In terms of actual structure, we're entering back into it. I've put in the expected weekly options highs and lows for this week. You'll notice it goes up to 192 on the high end. So some massive moves here, potentially expected again from Tesla. I mean, maybe they're not as big as what happened last week, but still 8% up or 8% down is the expected 68% of the time alert. Now, you'll notice I have set alert here. That's because this zone here will be where everyone FOMOs the absolute hell out of something like Tesla. And the reason is it'll be making a new high. This is where you've got to be ultra careful. Anywhere in this green box is effectively very careful zone. The way that the stock interacts with this area will be very important. I'm excited to look at Tesla this week. If you missed out on the bull rally, don't feel FOMO. Have a look at the gaps that have happened here. Huge gaps, huge left behind gaps everywhere. Just a few weeks ago, everyone hated the stock. Now everyone loves it. What's changed? Not much is the answer. Let's have a look at the options moving forward. You can see the calls. Look at them all jumping, all the calls everywhere. Everyone's happy. Retail's getting wild. Someone over here's got $270 call. they're probably not going to make any money. But again, 130, look at that base, too many puts there as well. So we know that this is the big strike zone for the week. Basically, that 160 seems to be where the fight is going on between the bulls and the bears. We're currently way higher than that. So as we start to see the options open up for the week, expect some big trading going on Tesla. This is the one, or people are watching this for the moment, and why not? There's huge moves on it. I continue to expect massive volatility, but we're in that absolute be careful zone. And yes, I will admit the 150, 160 didn't work out. I thought it would, but that squeeze was way too much. Now, I mentioned that I'd do a quick rundown on natural gas. Let's have a look at natural gas on the charts. Absolutely getting destroyed. Now, this could be fear or capitulation selling. Basically, everyone was bullish gas. I certainly wasn't, for good reason, I believe. That buy the rumor, sell the fact, in my opinion, going into winter was a pretty big play. Obviously, there were other things that ended up helping out on that. But take a look how far we are away from mean reversion. The 20 moving average is literally sitting like many percentage points away. They call natural gas the widowmaker, and there's a reason. It's almost 100% away from it because it's so extreme and so crazy. I don't usually like to play natural gas from the actual CFD or the futures market, but have a look where it is. It's getting closer to that 250, and somewhere around here is probably where I expect natural gas to baseline and start to find buyers. Remember, when everyone else hates something, maybe you start to like it, but only when it hits extremes. Most of you would have absolutely no love for natural gas or hate for it in general. So it's one of those asset classes, like any other asset class. If you don't have love or hate for it, then usually you can be more neutral and better at thinking through a process. So if you're not going to trade the widowmaker, what do you do? Well, you can go over to stocks and start looking at those. Are they forming accumulation bases? Remember, we did this with gold a little while ago, and I'm not saying they're absolutely primed right now, but here's just an energy company that has a little bit of gas, and you can see here there's some rejection wicks and a little bit of inverse head and shoulders action going on. It certainly hasn't run like the rest of the market. Here's another oil and gas kind of company here, just to show you again, forming bases on the lows. If you know how to deal with Wyckoff accumulation, if you know how to switch trends and things like that, these just are kind of levels where you pay attention, you set alerts, and we'll follow back up on it a little bit later on. But natural gas is heavily shorted and probably about to begin some form of squeeze, you would think. Again, I'm not recommending you do anything in particular. I'm just showing that these things are extremely oversold. And where does it end? Well, we never know that, but we can certainly see on the charts, natural gas was getting close to those 250 lows. Let's move over to Apple. So it broke through that downward trend line, and so many stocks did really well last week. I mean, there was so many stocks they broke out, they went crazy. I've got expected highs and lows. The expected high weekly options is actually sitting right on a big resistance as well. So if Apple does do well, really start to think about that level. I don't think we'll get through that easily because so many people will see it. There'll be a lot of profit taking between these kind of 150 to 152 targets. But yeah, Apple's through, low ends, only 140. Use the S&P 500 in comparison to Apple, but certainly some key resistances should we meet them. Let's move over to XLY, XLP. Now, we've used this to really figure out that sector rotation was on. And since this indicator broke out, it has been growth and psycho stocks and everything going very good. Yeah, it just had a massive session on it. Now, this just basically means that consumer discretionary absolutely destroyed staples as a comparison long short. Once you start to see these types of big candles like this, you need to start again being concerned because it's not usual. You know, it's unusual activity. You know, we've seen this all before. This is where you start saying, well, should I trim my position? That's what a bigger player would do. They would always trim. I love this indicator. It really shows us the health of the American consumer. At the moment, the market is in an absolute rip for this. Is it truly coming back? Or is it more likely probably some kind of trap? Well, we'll end up finding out. But inflows, they tend to tell us that not everyone on the street is convinced just yet. Let's look at the US 2000. I'm not saying they're early either. They're usually not. So they usually get in later, but they buy that kind of dip that comes after the big rally once they've done their analysis and they say, oh, yes, this is a great level for us. US 2000, no significant breakouts. We did get above 1900 in the close. We hit this little high here and you can see we rejected it. And the rest of the market did that. Indices across the world realistically did that. For you to see massive bear market moves, you're going to need to take something like an 1860 or this place down here that we already have alerted, which sits around 1800. But at this stage, it's at resistance still. It's at this really super critical zone for the Russell 2000. The Qs, let's have a look at the Qs. I've got the expected weekly options highs and lows for this one. We're again at super critical. Now, did the closure happen above the others? Yes. Does this look like a double bottom? Yes. Does it prove to the top? Yes. So have we broken through? Oh, I wish it was going to be easier to say yes or no. I mean, you have a look here. Yes, the daily's above. You can see that there's still, this is where we got selling last time. We had the Friday selling into the close. It's so close to call. And really what I think it comes down to more is the big news. Non-farms, FOMC, earnings. That's going to be what pushes it through. You find yourself at critical resistances and supports often ahead of these big bits. What will happen will most likely be a catalyst of that, but you'll be able to justify both on the charts after those events happen. You notice I've got this watch this high reaction that I had on these Qs. The reason is because I want to know what it does when it gets through a super critical high. And of course, the rejection did come through. Look at the selling, making a little low there on the 2 hour. Let's move over to the S&P 500 again. Based on the SPY itself, realistically an extremely big high here. We almost hit 410 on the real market, and some futures did hit it. And you'll notice here 413.54 for the expected weekly high and 397 for the low. A few of you over on Twitter said you really want 397. Yeah, but be careful what you wish for as well. If markets go down there, they may have broken a key level that we'll look at very, very soon. Unfilled gap wise, here are the main key levels that we've been talking about. If we end up breaching, we thought we'd get into this area here and potentially find some reaction. You can see again these wicks, these unfilled gaps, everything like that. So be very, very careful around here. If we end up blitzing it, I wouldn't be surprised at all to see the market back at like 42.83 and everyone to be truly losing their minds. Remember, this is a different rally to the other ones. Other ones went bang, huge run-ups, then sell-offs, basically dead cat bounces, kind of similar to what Tesla's doing. It's just doing a massive run-up without any base accumulation. Here we have what could be the beginning of a lightning bolt. Now, they're hard to find because it's way better accumulation, and dips in the future have really struggled to get through the lows as easily. Let's move over to the futures market action, and you'll notice I've got watch this zone sitting under 40.44. We ended up finding some buyers through the commitment there, and they rallied it up. Now we have kind of like a higher high. We hit that previous daily close. We almost hit 4,100 on this market. Obviously, we've got unfilled gap above at that 41 kind of 30 zone. And we know that there's some super critical, it's about there. We've got some super critical levels coming through. Monthly closes, daily closes, everything is happening here. And I think it's going to be news that pushes us through. These are the types of weeks where even though it's a little expensive, options usually are people's best friend because it protects you from what could be incredibly wild swings. If we break through, could we be going for even more bullish days? Well, let's go back over here just for a second and look at the daily. This is super rare. 1, 2, 3, 4, 5, 6. 6 bullish days in a row. Yes, some were opening down and then they ended up moving up, but 6, that's not like 3 or 4. That's a hell of a lot. And if you go through history, it's incredibly rare to be able to hold these. So 1, 2, 3, 4, 5, 6, and then it ended up going down after that. These are the types of zones where even if you count anything out in the past, you don't tend to get this many bullish closes at the end of the day. Critical zone, bullish closes, very, very careful. Here's, again, just those levels. You want to definitely be looking at that kind of 41.3 level. If that ends up breaking, we'll probably move into the 4200s. And you're looking at reactions around these zones this week. If we do end up seeing selling, expect around that 40.44, 40.45 to see buyers recommence. If they don't do it when we move down, then we could be starting to see the beginnings of potential weakness. But yeah, it's still critical. I wish it wasn't. The 2 hours at the end, you know, the last kind of little bit where we saw the selling, does that mean anything? I mean, it means a reaction to this zone, but it doesn't mean enough yet to make major calls either way. Let's have a look at the options market for the week ahead. 410s and 416s on the 30th. If we move over to the 3rd of February, which is the big one, we're getting close on 1 million units, not that much in comparison. 410, again, being one of the major strikes. And then we've still got a lot of puts in the system. 395s and 390s, still a lot of puts. So we've got puts everywhere here, and we've got calls on the top end. Anywhere in this zone is safe for the market makers for now. Expect this to make big moves throughout the week as we see hedging and everything else into the FOMC and the earnings reports. And it's going to be one to watch. We'll cover it every single day as the markets are open. Let's move over to Bitcoin, and it's still doing the same thing. It's just floating around this level. Very key point for it. I've got a little purple alert up here, 25,265. If that level is taken, watch the instant reaction to it. If it instantly shorts, be very, very careful. At that point, you're probably looking at, you know, high risk but decent reward style short positions. For now, what's going on though? Well, it's still in an upward trend. There's no reason to sell Bitcoin yet. If it takes out this level, 22,289, we'll be taking out 3 wicks. So those 3 wicks basically shows demand would be getting taken out. We move to the next level of equilibrium, which would be down here around that 20,500. So yeah, I mean, shorters cannot really reshort Bitcoin at this stage. And longs, well, they're just sitting there waiting for maybe possibly some really strong breakouts past these zones. We're in what we would call, you know, some people's take profit zones, and we've entered the green box. So yeah, we're at a key critical point for Bitcoin this week. Let's have a look at how big this news really is. We'll scroll down here. Wednesday, we have ISM manufacturing PMI, JOLTS job openings, 10 a.m. New York. 2 p.m. New York, FOMC statement, the funds rate expected to go up 25 basis points. What if they do 50? Wow, I don't think they will, but what if they did? Then we get the press conference. That's usually where you see that volatility coming through on the markets. And then we scroll down and it gets even more scary because we've got a whole bunch of other central bankers, pound, Europe, all coming through. And then we get non-farm payrolls and ISM services PMI. So this week is like mind blown in terms of moves. We have earnings reports that are massive, big tech stocks. This basically marks in many people's versions the end of earnings because we've seen enough at that point. Then we move on to FOMC, non-farm payrolls, everything. And it is all happening here this week. Make sure to subscribe to the channel and definitely give us those thumbs up if you like these kind of videos and you enjoy the detail that we go into. And do remember to check out the sponsor of today's video, which is Tiger Brokers. Links in the description down below. You've got until, I believe, the end of this month to be able to apply, fund it with as little as 1 cent, and you go into the prize draw as well for our giveaway, which we've sponsored, which is basically us giving away one of each of our courses. So if you want to go in and get some really good odds of potentially having that opportunity, check them out. What have you got to lose? Bye for now.